Okay, here is just the structure again to refresh your memory. Let's look at the rest of the court's decision. Okay, so we've looked at the burden of proof, the standard review, and the threshold considerations. Let's look at the respondent bottler's CPM method, and then we're going to address the reasonableness of CPM, and then we're going to talk about the bottlers as comparable parties. Part C, data assumptions, comparability adjustments, is pretty much what you would see in a transfer pricing study, a benchmark study, and yeah, I will leave that here as it is more about compliance and documentation than legalities. If we look at the respondent bottler CPM, the introductory chapter to this, there's a couple of highlights that I want to point out to you. The first is where the court said in different places in this chapter. This is also a chapter, by the way, where they showed how, all the supply companies were the most profitable food and beverage companies in the world that we've seen in one of the first slides in the previous video. So what they say is respondents expert Dr. Newland employed a CPM that benchmarked the supply points profits to the profits earned by the independent Coca Cola bottlers. We know that. He concluded that the best profit level indicator was a return on assets, i.e. the ratio between operating profits to operating assets. I found it interesting that it was assets and not, for instance, total cost, but because I guess total cost would also include your depreciation, but we leave that for what it is. We conclude that the commissioner did not abuse his discretion by using the bottler return on assets to reallocate income between the petitioner and the supply points. But that is quite clear so far. We find that the bottlers in many respects, and we'll get to that in more detail later, enjoyed an economic position superior to that of the supply point joints, which would justify for the bottlers to have a higher relative return, right? Because they did a lot more functions and they carried more risk. Dr. Newland's choice of methodology was thus conservative. So, in short, the IRS was reasonable here. If we look at the selection of the reasonableness itself, what the court says about it, petitioner has identified no transfer pricing data for transactions with unrelated parties that involved the transfer of the same intangible, in other words, the Coca Cola brand. Therefore, the court says later, the reliability of any cut method is thus considerably reduced here because it cannot be a true comparable cut, right? And once it has been ruled out, the CPM is preferable in principle to the profit split method because petitioner owns virtually all the relevant intangibles. In other words, the Coca Cola Company owns all the relevant intangibles, saying by implication that the supply points owned none. And then if we look at the selection of the bottlers as comparable parties, and here he goes a little more, they go a little more into what the bottlers are doing and why they are comparable. They say, we agree with the commissioner's conclusion that independent Coca bottlers served as appropriate comparable parties for purposes of a CPM return on assets analysis. The bottlers are comparable to supply points because they operate in the same industry, face similar economic risks, being, I guess, in part being paid by Coca-Cola because that is also how the syrup prices were determined, right? Had similar but more favorable contractual and economic relationships with the petitioner. Employed in the same manner many of the same intangible assets, being petitioners or Coca-Cola's brand names, trademarks, and logos, and ultimately shared the same income stream from sales of petitioners' beverages. So that's why they were comparable. And again, also remember that for a CPM method or a cost plus or a TNMM, whatever you want to call it, the level of similarity can be lower than it is for cut, right, or for cup. And then I want to just raise the last point on this subchapter on what has been discussed, and this is petitioner contend that supply points bore marketing risk because they funded consumer advertising in foreign markets. So what happened was that the servcos would charge some of their costs for marketing and everything else to the supply points. and or that would get charged via the Coca Cola Company. Either way, in some respects, the supply points paid some of all the marketing costs that the Servcos bore, right? And Coca-Cola tried to argue, well, I mean, if we paid the cost, then we must have done the job and carried the risk. And this is where their argument fails, because the court says the supply points had no operational responsibility for consumer marketing. They thus bore no risk in the sense of mission failure. Rather, petitioners simply charged certain Servco marketing expenses to the supply point books, and it made these charges roughly concurrently with the supply points receipt of vastly larger sums of income from bottlers. So it was simply a way to cream off some of the income from the supply points. But it was done randomly. There was no system in it. You couldn't say it was the court spent quite some time on that. You couldn't say that it is turnover related or anything. It looked like it was totally random how the Servco costs were allocated to the different supply points. And this is the weakness in, I think, Coca-Cola's case, is that the transfer pricing documentation and contracts and practices between them and the supply points were severely lacking, one would say. I mean, they moved functions without compensation. They made charges without justification. There's a lot of things that went wrong here, right? So it was just another way to cream off, I think is what the court says, some of the excess profits of the supply points. And they end with this line, which I think is quite strong. We do not see how the supply points bore marketing risk in any realistic sense. Risk is not something that can be assigned after the fact. Now, it's a sentence that sounds very strong. I'm not 100% sure what they mean with it. I mean, is it the fact that they've at year end maybe allocated some of the Servco costs, and therefore they cannot assign the risk that way? I'm not sure, but the sentence in itself is correct. Risk is not something that can be assigned after the fact. Risk is because you don't know what's going to happen, so you can't, after you figure out what happened, says, okay, well, now I carry the risk, right? And then petitioner contends that the bottlers were marketing light business. In other words, because some of the costs were charged through the Servco and they paid for this marketing, the Coca-Cola said that the bottlers were just doing the easy marketing stuff, right? Whereas the supply points certainly had marketing intensive operations. And the court keeps its patience and says, as explained more fully below, we disagree with the former contention. The evidence at trial showed that bottlers in the aggregate paid about as much for trade marketing annually as TCC and its affiliates together paid for consumer marketing. They make this difference where they say consumer marketing is directed at the consumer and trade marketing is what you do to get the stores to sell to the consumers. For instance, you would get refrigerators that you would put right next to the cash register or close to the cash register so that the consumers can always get the Cokes whenever they want, right? And that was part of the trade marketing. And there were huge budgets spent on having these refrigerators close, for instance, to payment points. The supply points did not, again, the latter contention is simply inaccurate. The supply points did not have marketing intensive operations because they engaged in no marketing operations. All consumer marketing activities were undertaken by TCC and the Servcos. The supply points simply had these costs charged to their books via intercompany accounting, right? And then they end up by saying, we focus on the economic functions that they actually performed and the risks they actually assumed, not on intercompany charges made by their parent. And again, it is a strong, but I think considering the facts, fair statement to make. The second to last chapter that we're going to look at now is split invoicing. And just to explain what it is, let's read what it says. We now turn to respondent's split invoicing allocations. And so in his amendment answer, respondent, that is the tax authorities, reallocated an additional $385 million of income to the Coca Cola Company from 6 service codes that benefited from split invoicing during 2007 to 2009. Where split invoicing was employed, a supply point invoiced the bottler for a portion of the concentrate price, and a local servco issued a separate invoice to the bottler for the remaining of the concentrate price. Okay, so there are 2 issues here. First is actually the supply companies lost some income because these were charged by the servcos instead, right? But of that, the court says, well, you know what, they still earned too much, and the IRS benchmarked what they should have earned and deducted the excess from what they actually received, right? And then the other issue is, well, what about the servco income? Was that actually belonging to the supply codes and then charged to the servco, or what the servco just split the income with the supply codes? And the court says it doesn't really matter. I mean, we know that the servcos were compensated on a cost-plus basis in general. If you look at the next sentence here, the services for which the servcos were compensated via split invoicing were indistinguishable from the services that they rendered directly to TCCC and export. So they already have, we know the benchmark for what they earned for those. So whatever they earned from and they earned that. So whatever they earned from the split invoices was too much, right? And that simply has to be reallocated to the Coca Cola Company. So on either theory, whether it went via the supply codes or whether the service codes invoice got this income directly from the bottlers, in short, the bottom line is the same. Since the extra income received by the 6 servcos, there were only 6 of them doing this, was in excess of their arm's length income, it must necessarily be reallocated to petitioner as the owner of the value intangibles. We thus hold that the respondent has carried his burden of proof with respect to the split invoicing. In other words, the $385 million adjustment for these 6 service codes was justified. And then there's a whole chapter, close to 100 pages or 50 pages on petitioners' arguments, and I'm not going to go into detail with them because most of the arguments have been covered in the text discussed so far. There's a lot of text about these marketing intangibles, which the supply codes are supposed to have owned and should have been compensated for, and the court is quite brutal in responding to the petitioners' arguments, and quite frankly, if you look at the substance of their arguments, one does have sympathy with why the court does this, right? But here are some of the texts. The supply points played no role in arranging consumer marketing and had no voice in selecting or evaluating the service for which they were thus made financially responsible. In essence, they were passive recipients, that's what we talked about before as well, right, of charges that the HQ and BU leadership put on their books. But because petitioners saw it fit to put those charges on their books, petitioners' experts assert that the supply points thereby acquired marketing intangibles worth tens of billions of dollars. And I think Coca-Cola is not the only one that uses this line of argumentation. So, it is a general warning. The fact that you pay for something does not necessarily always mean that you own it, especially if the billing intercompany is as messy as it's been between the Coca Cola Company and export and specifically the supply companies, right? So listen to this. I mean, we find no support for petitioners' argument in law, in fact, in economic theory, or in common sense. That is absolutely brutal, right? To the extent the servco's consumer advertising expenditures added value, those expenditures did not create new intangible assets owned by the supply points. Rather, the advertising enhanced the value of the trademarks and other intangible assets that were legally owned by the TCC. So, even if these costs did increase value of intangibles, those were Coca-Cola's intangibles, and they remain Coca-Cola's intangibles because that's what the contract said. It said that Coca-Cola owns all the intangibles. The supply companies and the service codes didn't get any of those intangibles, right? Plus, Coca-Cola could eliminate or change or terminate the contracts with the supply co almost at random and with very short periods. So even if there was an intangible, it would be there the one day and it will be completely gone the next. So that was with regard to that. And then you had these supposed long-term licenses where the experts try to claim that, well, even though in theory, or even though in practice the licenses are short between Coca-Cola and the supply companies, in theory, Coca-Cola cannot deal without them. And the court basically says, well, it can deal without one of them or two of them or maybe even four of them. It has reduced its number of supply companies significantly. And you can't look at all the supply companies together and say you can't deal without all of us. I mean, they can, for the individual supply companies, they are very easily dismissible, right? And then what is interesting is point E, the alternative transfer pricing methodologies. And here, 3 different experts, quote unquote, came with 3 different proposed methods. To the IRS method. Magically, all 3 relied on the fact that you allocated or that you combined the supply codes and the service codes, and then therefore the supply codes got all the intangibles, which apparently the service codes were supposed to have generated, even though the taxpayer agreed that the service codes were compensated at arm's length. And the court makes a short notice of these arguments, and probably the most clear and again most brutal is what it says about the expert that came with a proposed cut method, where when the court responded, it says there are so many flaws in Dr. Uni's construct that it is difficult to know where to begin. That must hurt. What must also hurt is the next phrase. But to start with the basics, right? This is what I wanted to tell you about the Coca-Cola case. I think it's an interesting case. I think there are some lessons to be learned from it. It is quite obvious. You cannot allocate activities and supposed assets from companies in one country to companies in another country if they have done nothing to deserve those, right? That's not a surprising lesson to learn. I think this thing with that they supposedly owed intangibles because the costs for intangibles were charged to them, even though they've done nothing to get those intangibles, is maybe a lesson to take away from this case and consider further. And then, again, I think when taxpayers make arguments before the court, be real. Don't come with silly things where you deem up businesses and deem up assets that don't apply. Last week, when I talked about the Danish authorities, I said, they have a tendency, at least that's what it looks like from the outside, to always rush to reject the taxpayer's documentation for sometimes very silly small things. Or supposed transactions which the taxpayer didn't even know that they had, in order to turn around the burden of proof. And that is also something that one shouldn't do. I think if we got to a world where both tax authorities and taxpayers focused more on finding the right answer instead of trying to be right, transfer pricing might end up being a lot simpler. Bye for now. Next week more.